A very good morning to my teachers. Today we are going to give a presentation on market view based on the topic foreign exchange market. My name is Jalin Hao.
My name is Samantha.
My name is Shang Wenduan.
Exchange rate is defined as the price of one currency in terms of another. Exchange rate can be determined by the buying and selling of decision of those who trade in the foreign exchange market. The two currency pairs that we have chosen to analyze are Australian dollars against US dollars and Australian dollars against Japanese yen. The first currency we are going to talk about is Australian dollars against US dollars. The current exchange rate of Australian dollars against US dollar is 1 Australian dollars equals to 0.754708 US dollar. The day range is between 0.7474 to 0.7552 US dollars. Relative inflation rate. Currently, both Australia and the United States have inflation rate of 1.0%. Both countries have low inflation rate due to some of the factors affecting inflation rates, such as weak global economic growth and inflation expectation. Weak global economic growth tend to reduce the investment, demand, and potential output of one country. This could also put a downward pressure on the inflation rate. Inflation expectation. Reserve Bank of Australia inflation expectation is 2 to 3%, whereas US Federal Reserve Bank of its expectation is 2%. Although both countries have inflation expectation around 2 to 3%, however, they did not reach their inflation target. Besides that, RBA also expect inflation to remain low for quite a while due to the subdued growth in labor costs and also very low cost pressure elsewhere in the world. Relative interest rate. Australia interest rate is 1.5% and United States is 0.5%. Again, both countries have low interest rate. RBA monetary policy. Recently, RBA has cut cash rate to 1.5% in order to stimulate the economic growth. Low interest rate would have adverse effect on exchange rate. As you can see from diagram 1, demand shift to the left and supply shift to the right. Demand shift to the left because there is less capital inflow, as low interest rate would attract less foreign saving, leading to the less demand of Australian dollars. At the same time, supply shift to the right because there is more capital outflow, leading to the rise in supply of Australian dollars. As a result, this could put downward pressure on the exchange rate. US presidential election. Interest rate is expected to increase after the US presidential election due to the improving economic growth. There's also an expectation of 2.5% of economic growth after the election. If interest rate is really increased in the future, then it would have upward pressure. It will put upward pressure on the exchange rate. As you can see from diagram 2, demand curve shift to the right and supply curve shift to the left. Demand curve shift to the right because there is more capital inflow, as higher interest rate will attract foreign saving, leading to higher demand of US dollars. At the same time, supply curve shift to the left because there is less capital outflow, leading to the fall in supply of US dollar. This would put an upward
Commodity price can be another reason which affects exchange rates. For Australia, as we can see from the pie chart, the bulk commodities and other resources are the major components of commodity price index in Australia. The change in their prices could affect the value of the Australian dollar. Australia is one of the largest export economy in the world. Low commodity prices would decrease the value of a country's export and put downward pressure on the exchange rates. Australia is one of the world's biggest iron shipper, and part of Australian economy depends on the iron ore exports. Recently, the price of iron ore has fallen, which may put downward pressure on the Australian dollar. In the world economy, China plays a critical role, and when it slows down, even just slightly, everybody else would be affected, since China is making transition from an industrial to a service economy, which result in less demand for commodities like iron ore and this kind of raw materials. China is considered as Australia's biggest trade partner. This transition could decrease the export of Australia, which affect Australian commodity price and slow down the Australian economy as well. United States is biggest importer of crude oil, so there is an inverse relationship between United States dollar, US dollar, and oil price. When oil price drops, US dollar would appreciate. So overall, as we talk about, due to RBA continuous cash rate cuts and expectation of interest rate increase in US after presidential election, as well as dropping commodity prices, we expect the Australian dollar would depreciate against US dollar in 3 to 6 months.
The exchange rate for Australian dollar against Japanese yen is 1 Australian dollar is equals to 76.9449 Japanese yen, and the day range is equals to 76.705 to 76.898. For the relative inflation rates, Australia inflation rate is 1% and Japanese yen is negative 0.3%. And factors affecting the inflation rates. Australia has a higher inflation rate compared to Japanese yen, which means that there's less demand for Australian exports due to more expensive export prices, resulting in less demand for Australian dollars. The total inflation rate in Japan has been dragged down by falling oil prices. Bank of Japan is seeking to achieve a 2% inflation target to bail the country out of deflation. And the negative effects of low oil prices is that companies could be discouraged from raising retail prices and wages, and consumers could procrastinate over purchases as they wait for prices to go down. For the relative interest rates, Japanese yen moved the official interest rate down a notch from 0 to negative 0.1% in January 2016, and Australia interest rate for 1.5%. The Board of Japan has signed the negative interest rate policies, and the main goal of this policy is to let central banks encourage greater investment and inflation using domestic savings, not to place downward pressure on their currencies, and lowering interest rates could meet their inflation targets. But with negative interest rates, central banks charge a fee instead. The idea is to encourage banks to put their money to more productive use, lending it to households and businesses. Australia has higher interest rates compared to Japanese yen. Higher interest rates in Australia would attract foreign savings, leading to higher demand of Australian dollars. At the same time, higher interest rates in Australia would decrease supply of Australian dollars, as it is less attractive to save abroad. This would put an upward pressure on the exchange rate, and Australian dollar would appreciate against Japanese yen. For commodity price, the low oil prices does not affect much on the commodity prices, as cheap oil prices will help boost the real economy through reduced cost burdens on businesses and households. If oil prices can lead to increasing investment and consumption, prices will be pushed up. So in order to achieve the 2% inflation rate, falling oil prices must fade away. And since Japan is Australia's second largest trading partner after China, Australia has struck a trade surplus with Japan, which means that the value of Australian exports exceeded the value of imports. The trade surplus provides a downward pressure on the Japanese yen to Australian dollar exchange rate, and the amount exported by Australia is significantly larger than the value of goods imported from Japan. For the relative economic growth rate, Japan's GDP growth is 0.2% and Australia's GDP growth is 1.1% quarterly. The higher GDP growth rate in Australia would put upward pressure on the exchange rate. And the expectation of the exchange rate in the next 3 to 6 months is that we expect the Australian dollar to appreciate against the Japanese yen. And the commodity prices started a silent recovery in 2016, which we expect to continue going forward. This silent recovery in prices will be a boost to net trade numbers as Australia imports from Japan has been steady over the last decade. Thank you for watching our video.